Paul, thanks for inviting me for this talk, and thanks for giving me this opportunity. And I would just like to add, I was at the same batch as Professor Bandyopadhyay, Aditya Bandyopadhyay, and we were actually even roommates. So we have known each other for a long while, and so it's great to be back. And I actually would have loved to do this call in person. Uh, Maybe we can see this next time around. But yeah, so what I will do is I will quickly share my screen, and then I can go through what we are going to actually talk about. Please let me know when it's visible. Everybody can see the slides, I hope.
Yes, they're visible.
Okay, great. Great. So as you can see, the topic of the talk is impact of global finance on our lives. Like very first, like as you can notice, I've changed the topic slightly. The initial topic was impact of global financial markets on our lives. I've actually made it broader. So I'm talking about the entire global finance and not just financial markets. Because a lot of things move together, like along with financial markets, macroeconomics, etc., come into the picture. So the basic idea is to understand in this particular talk how financial decisions happening in countries very far apart from us affect us and what we can do to protect us from unexpected situations. And as you can see, the subheading is basically a joke. Joe Biden doesn't really have anything to do with Swiggy, but there is a kernel of truth in that. As I said, financial decisions being taken in countries far apart from us can affect startups in India, can affect our jobs, can affect everything. So that is what we are going to talk about. Now, again, so what this talk is about, this is something which I want to clarify very early on in case, just to prevent myself from digressing and just in case there are some wild expectations. First, this talk is not about investment advice. I'm not going to tell you which stocks to invest in or which startups to invest in. That's not what I'm going to do here. I'm also not going to give you a macroeconomic or a financial trading lecture in this particular talk. Uh, there are much in IIT. There are much better courses which can teach you these topics. And as Aditya mentioned, I'm actually a founder and CEO of my own startup, but I'm not going to touch anything related to that in this talk. What I'm actually going to talk about are some, as I said, a very high level financial and economic concepts from all around the world, especially those things which affect us, like everybody in this call, students, teachers, professionals, everybody. And well, I'm also going to talk about what we can do, as I said, to protect ourselves and to, help ourselves when something big happens, and to avoid some common mistakes which people do related to finance. Now, I'd like to clearly specify a lot of things which I'm talking about are overly simplified. They're not necessarily mathematically rigorous or technically the only way to look at things. Because I'm touching topics from various different fields like quantitative trading, macroeconomics, uh, microeconomics as well, financial markets, etc., and not going deep into any one of them. Also, a lot of things which I'm saying, you should not accept them as gospel truth. What I'm presenting is one viewpoint, and many arguments can have counter arguments. So you should also do your own research afterwards. And I'm happy to give the link for this deck, which which everybody gets free to go through later on. Okay, and lastly, nothing is financial advice. Please, I'm not legally allowed to offer financial advice to anyone. So please don't don't consider this as a suggestion to invest in any stock or any startup. That's not what this call is about. This is more of a legal disclaimer which I have to do. Now, so this talk is basically divided into two parts. First, what we need to know and understand, and second, what we can do. The first part is the most of the has most of the content, and towards the end, I will talk about what we can actually do. So this is where we are starting with. So, as I said, I'm not going into very technical details, but I'm starting from very fundamental concepts. The very first concept is money. Now, question is, what is money in the first place? Now, is money the 100 rupee note which you have with you, or is money your bank balance? What exactly it is? And why even talking about money in this talk? It will become important very quickly. But basically, the formal definition of money is like a medium of economic exchange, which basically allows us to live in civilizations, trade with each other, and instead of physically bartering one item with another, instead of selling a cow for getting, you know, uh, rice, we can actually use money as the actual medium of exchange, which can be currency, it can be gold, it can be digital currency, anything. And it is also a measure of wealth. Now, the point of defining money at this point is to explain that money and wealth are two different things. Again, why in the context of global financial markets and trading, etc., I'm talking about this is because the distinction between money and wealth is important to understand what's actually going on and what we can actually do. So again, what happens when you use money? So even to understand what money really is, we need to take even a step back and understand how human civilizations work in the first place. Now, everything which we use, goods and services, they are produced by the effort of other people. Like if somebody is like a barber cutting your hair, then you're directly using a service of some other human being. Now, if you're using a pen, then that is a good which is produced by maybe in a factory and is produced by effort of a large number of people. This actually goes way beyond what is happening in factory because there are raw materials which are required to be extracted from maybe earth and need to be converted into components of a pen and then to be assembled together to form a complete product. A lot of people involved at a lot of points. And the more complicated a product is, for example, your phone or your laptop, more human beings are involved in the creation of that product. And the entire foundational basis of human civilization is collective effort of humans. Like one theory about the fact that humans are the dominant species is because we can very flexibly cooperate with each other on a large scale. And when we buy something, we are actually purchasing this collective human effort. And this is what we need to understand, what we're actually doing. So this is what we do when we actually buy something. And we do this by basically exchanging money to get the good or the service. And indirectly, we're getting the actual human effort. Now, this is why I even went into that direction was to explain how wealth is different from money in the first place. Now, I talked about money as a medium of exchange, but then what is wealth? Wealth is basically the ability to obtain these goods and services which have value for you. So basically, it's the ability to obtain this collective human effort. That's what wealth is. And wealth can even be defined as the ability to produce these goods and services which are valued by other people. Now, what I'm talking about here, I'm basically saying that simply because you have, let's say, 100 rupees note, does not necessarily mean you have wealth. But if 100 rupees note could be used to obtain some physical good or some service from someone, then that is the representation of wealth. Why I'm saying that? Maybe that 100 rupee note, something has happened and 100 rupees note has no value. Then you have no wealth, even though you have money. And when it comes to actual goods and services, obviously the ability to collect them is wealth, but the ability to produce them is also wealth. And that is a stronger form of wealth. So if you own factories or businesses, that is obviously a wealth as well. Means of production are the true representation of wealth. Now, all of this until now is somewhat academic because we don't care like what is money, what is wealth. If we have some money, if we can get things which we need, then it's fine. But we need to understand that these things hold true obviously for us, like for individuals. But these things also hold true for companies. And more importantly, these things also hold true for countries. So countries can have a lot of money, but not enough wealth. And that can be a huge problem. And we'll go in deeper into this particular scenario. So basically, money is not wealth and is true for everyone, individuals, companies, and countries. There is one exception, one country is an exception to this rule, which is USA. And we will get to this why that is the case later on. Now, this is where we start actually moving towards now more global finance slowly. So we went through what is money and what is wealth and why these two things are different with each other. But let's focus more on money now, and let's focus more on money at, let's say, at a country level. Now there's a term called money supply. It's a macroeconomic term, but it's hugely important term for everybody to understand. And as I said very early on, I'm not being very accurate in everything, but the point is to get the message across. So there are a lot more definitions to this particular term, which I would suggest everybody look up later on. But basically, the money supply is defined as the total of all currencies and liquid assets in an economy. It basically means all liquid cash and liquid deposits, etc. So this money supply basically refers to how much money a country has. That's all what we need to understand for now. Now, technically, there are many definitions. There's M0, M1, M2, M3, different levels of money supply. But for this purpose, we just need to understand that basically money supply is the total amount of money in a country. Then money in a country is basically created by two parties, two types of parties. There are central banks and there are commercial banks. Now, central banks create money in many different forms, and we will go into very deep in this particular direction. And commercial banks also create money via loans and everything. But the point of the matter to understand here is money supply, which as I said, is basically how much money is circulating in the country. That is basically created and controlled by the central bank and the commercial banks in the country. Now, so the first part is, and from this slide onwards, we will actually start getting more into the actual world itself and not just theoretical definitions. So the first part is, how do central banks actually create money? Now, central banks basically have 3 or 4 primary tools for creating money. The very first tool is interest rate. Now, every country has central banks. Almost every country has central bank, and generally the central banks are supposed to be independent of the political leadership. Generally, that's how it's expected to be. Whether or not that's the case is a different matter. But one of the most important tools which central banks have for creating money is interest rate. Now, every country has one benchmark rate which is used for lending and borrowing directly between the central banks and the commercial banks. So in US, it could be US Fed and JP Morgan Chase. In India, it could be RBI and State Bank of India. So one of the ways central banks can create money is lowering interest rates. Because if they lower interest rates, then banks can borrow much more from the central bank, and therefore banks have a lot more money, and therefore they can actually lend out more and pass off that money in the economy. Now, one real life fact which we need to now understand is that the US central bank, also known as US Fed, basically dropped its benchmark interest rate to 0 in March 2020, and it was 0 till February 2022. That is one of the things which we should remember. This is not the first time it was dropped to 0. This has been done in the past multiple times. But in the recent history, this was a period for roughly around 2 years when it was exactly 0. This is how more money was created. But there's another aspect to this, which is called reserve requirements. So, when banks, commercial banks lend out loans, they have to keep certain amount of money with them, or with them I mean either with them directly or deposited in the central bank for every rupee of loan given out. So for example, if they have given out 100, if a bank, let's say, has given out 100 rupee loans to maybe 100 different people, then they need to keep 10 rupee as reserve somewhere. Now this implies the reserve ratio is like 10%. It's actually less than that. But what this means is, if you invert the thinking here, if the bank has 10 rupees with it, then the bank can loan out 100 rupees. This is how money is being created. Bank simply had 10 rupees, but it lent out 100 rupees, and this 90 rupees are basically coming from thin air. Now this is what is called fractional banking system, and this is the world we live in, where banks do not have to actually keep reserves at 100%. This is not the only way to do banking, but this is the most common accepted in almost every country in the world. But what this means is, there is another parameter which can be tuned to increase more money in simply the reserve ratio. So in this example I gave, the reserve ratio is 10%. Now the central banks are the ones which decide what reserve ratio should be. So if central banks come and say, hey, reserve ratio can go as low as 5%, then with the 10 rupee which the bank had, now they can loan out 200 rupees. And many of these 200, a lot of this 200 rupees will come back to the bank again. Let's say 20 rupees further comes back to the bank. So now the bank has 20 rupees additional. Now they can loan out 400 more rupees. And this keeps on circulating. There's a concept called money multiplier, but which you can look up, but I'm not going technical details of that. The point here is, this is the second parameter which central banks can tweak to create more money. Again, coming to more real life situation, in March 2020, the US Fed reduced the reserve requirement to 0%. Basically meant that the commercial banks there can basically create.
Hi, Deepanshu, there's a bit of noise at.
Okay, sorry. Yeah, I know what is happening. Yeah, I will take care of it. Is it better now? Yeah, I guess it should be better now. If it.
It's okay.
Okay. So in 2020, March 2020, the US Federal Reserve, basically US Central Bank, reduced the reserve requirement to 0%, which meant that the commercial banks there can basically give out infinite loans. Now it's not technically correct. There are some other parameters, but this was the situation. And it will become very obvious why I'm talking about this particular time period over and over again. But before that, we have to look into the third way how central banks create money. Now, the third way central banks create money is something called open market operations. Now, this is done a lot by US central banks. This is not done that much by Indian central banks, though they do it as well. But this has been done a lot in the US central banks in recent history. Now, what they do is that they buy some assets from commercial banks and other financial institutions. What does this mean? It means some asset which the bank had, the commercial bank or the financial institution had, which was not very liquid, which was not easily available for other to sell, or which could not be used very easily, has been absorbed by the central bank, and the central bank in its place has given a lot of cash. Now this basically starts going in the direction of money printing. This was what the basis of the quantitative easing which happened in the entire 2010s by US government. But more importantly, coming to the March 2020 period again, between March 2020 and June 2020, US Fed basically bought $3 trillion worth of assets. Basically, US Fed provided $3 trillion worth of cash to the banks there just in 3 months. It provided another $2 trillion of cash to banks in the next 2 years. $5 trillion of money was created in these 2 years of time. Now, Something related to this is something called debt monetization. This is literally printing money. It's not even close to printing money. This is actually printing money. Now, what happens here is, in this case, the central bank is directly buying the asset of the government. In this case, when I say assets, I'm talking about generally government bonds. Now, government bonds or bonds in general are just a representation of a loan. So when government is issuing a bond, it's basically taking a loan. So anybody sells bonds to take loan and buys bond to close off the loan. So in this case, when government is selling the bond to the central bank, and the central bank is basically buying, uh, instead of the central bank is basically buying the government bond and giving it cash, then ultimately this is just creation of cash given to the government directly. And as I said in the beginning, generally central banks and government are supposed to be independent of each other, but this is one legitimate way they are supposed to interact. But this is literally printing money. And again, since March 2020, US government has printed trillions of dollars. And whether this is good or bad is something else, because this printing of money is different from this printing of money, and it was used for various purposes. But for us, what we need to understand is a lot of money has been printed in various forms by the US government since March 2020. This shows you the money supply in United States in the last 60 years. This chart actually starts from something like 1950 or 60, and if you see till 2020, it's increasing, but not increasing like a vertical line. And if you look at 2020, this chart has basically become a straight line. This is not some video game or some crypto going on. Like you're having infinite supply or something. This is actual US dollar money supply. This is what has happened in the last few years. If you don't remember anything from this talk, remember this chart. This is the most important chart you will see in this talk. Again, the US money supply. This is in this chart is something called, this is a chart for a definition of money supply called M1, which is different from M2 and M0 and all. You can look up the definitions later on. But the point of the matter is, roughly $16 trillion of money change happened in money supply in a few years. That's a lot of money. Now you can see towards the end, they have started decreasing it, and I will explain why it has to be decreased. But if you look at that vertical line, you need to remember that is not normal. That has never happened in the history of humanity before. That is a very abnormal thing, and that has affected everything which we do. Now, so let's look at what happens in the short term and the long term of such a behavior. Now, first of all, this money printing, whether it's done by government borrowing from the central bank, or whether it's done by central bank directly doing open market operations. One of the reasons this was done was to give money to the people, especially after the coronavirus pandemic shut down everything and everybody in March, April 2020. So the entire economy has shut down. So one way to prevent this becoming a catastrophe was to give money directly to the people, and or to make loans easier to obtain. So this is one of the reasons money was printed a lot. But the problem is, this can and did lead to inflation. Now, inflation, I hope we all understand. Inflation is basically the change in prices, and very high inflation is bad for everyone. We see how much the price of tomatoes are rising right now. But in general, inflation is, if it's too high, it's quite bad for everybody. And one of the reasons why this much of money can lead to inflation is because of the thing which I talked about in the beginning, that money is not wealth, and it is true for a country. So if you print a lot of money in a very short period of time, but the value of goods and services produced by the country has not increased, then the wealth of the country is where it was, but the money has increased. And the value of money the much larger amount of money is chasing the same amount of goods and services. Therefore, the value of goods and services in the context of the money increases. This is why I talked about money versus wealth in the very beginning of the call. But anyway, at least it did not lead to inflation immediately. And to be honest, this is not the only reason for inflation. There are many other factors like supply chain issues, which also led to inflation later on. And there are other macroeconomic theories behind inflation which counter this argument. I would suggest interested people to look it up. But this is a very big factor which led to inflation. But it did not lead to inflation very immediately. It took some time. Also, the short-term impact was that it was easier for companies to get loans. So therefore, they had much more cash. And especially in the immediate aftermath of the lockdowns, many companies had zero revenues. So they had to survive, they had to have cash. So this printing money helped them. It allowed them to make payrolls. It allowed them to continue hiring, to continue expanding and stuff. And now, this is where things start getting even more interesting. This is a huge amount of money. A lot of this money actually ends up in financial markets. And if you look at stock prices all over the world, stocks, bonds, everything was making all-time highs every day. Like 2020, 2021 saw such high bull runs that it was like unprecedented anywhere in the world, and any other time in the history. Now, a lot of this could be explained by economies doing well, but a lot can be simply explained by the fact that a lot more money chasing very few assets. So this was one of the reasons why the stocks and bonds, basically financial markets, were doing very well in 2020 and 2021. Now, interestingly, a lot of this money, this is so much money, it has to go everywhere. So a lot of this money even goes to private capital. This includes private equity and venture capital. And venture capital then gives a lot of this money to startups, and private equity gives a lot of money to mature companies. And therefore, startups had a lot more money than what they would have in the normal circumstances. So there was a lot of hiring, there was a lot of marketing. But the same rules apply even for startups and for companies. Having more money does not mean you have more wealth. The role of a company is to create value. And just because you are spending a lot of money, does not mean you're actually creating a lot more value. And I will come to this in more details what this led to. The one last short-term impact was that governments other than US could basically borrow dollars at a very low interest rate, because US government, as we saw, had reduced interest rate to zero. So many governments had a lot of money as well, basically getting free money, free dollars, etc. Now, the governments don't get loans at 0%. Like, depends upon how risky a country is considered. It's 0% plus something. This plus something depends upon the risk of the country. For developed countries, this plus something is smaller. For developing countries, it's higher. But the fact is, the first component of this rate was zero. So therefore, for every government, the cost to borrow, the total interest rate was quite low. So every government, a lot of governments, not India, but a lot of governments borrowed a lot of money in dollars. And India not borrowing money in US dollars is actually a good thing, which we'll come to later. Now, all that happened in the first year or two. But then, as I keep on saying, money is not wealth. And there's an impact if you create too much money. And it affects everyone. And now we are seeing the long-term impact. First of all, as I said, inflation came up. And which was honestly not surprising to anybody who understands finance or economics. It became quite high in developed market countries. So, like in our country in India, like 5-6% inflation is not really considered bad. The RBI target rate is 2 to 6%. So 6% is like within target anyways. But in developed countries, they are used to 2-3%. Like 2% is the target rate. So they saw inflations like 7%, 8%, 10%. And in some cases, it's even higher. So this leads to a lot of problems. Obviously, if an entire generation has never seen an inflation of more than 2%, and now they're suddenly seeing 10% inflation, then they have a very huge shock in the way they live their lives. So therefore, inflation had to be controlled. Now, this now starts second order effects. Because now the inflation has to be controlled. So we have to do opposite of printing money. Because a lot of money led to inflation. So we have to take out money from the system to reduce this inflation. Which means all the three ways which are described now have to be reversed. Now we can do this. This is completely in the domain of central banks. So they did all of this. Every country started at different times, but every central bank in the end did take steps for controlling inflation. One of the most well-known steps they did was to increase interest rate. Like US increased from 0% in around March 2022 to around 5.5% now, and they're probably going to increase a lot. And this is a huge increase. This is a huge increase for a country with trillions of dollars in money supply. Another thing which central banks did was to withdrawing money directly from the markets. So they did reverse of the open market operations. I said they buy assets from banks and in some cases governments to give them cash. Here they did the opposite. They sold many of the assets and absorbed the cash from the system. So this is also sometimes known as quantitative tightening, which is the opposite of quantitative easing. And the third thing which central banks can do is increasing reserve requirements, though this was not a very popular technique in most countries. But they did increase interest rates a lot, and they did absorb cash from banks and governments directly. Now, obviously this impacts everybody. First of all, if you increase interest rates today, it will not decrease inflation today. It will take a few months at least, if not a year or so. Which means we ended up with a situation. By we, I generally mean people in the developed countries and a little bit of us as well. But the situation was, and currently still is, inflation is also high, our interest rates are also high. So not only getting loans is more expensive, if buying anything is also very expensive. So this was the first long-term impact which people ultimately suffer from. Now, similar things happen for companies. I mean, they also take a lot of loans and they have higher interest payments now because the rates have increased. And because the money is not that much available in financial markets anymore. So venture capital funding, private equity funding, that also goes down. And because everything is highly priced, inflation is higher, so their costs are high. So either people simply buy less, therefore the companies have lower revenues, or people buy the same, but the cost to produce that goods or service is very high for the company. So the profits are low. Therefore the companies suffer. And financial markets also start coming down because money is simply being reabsorbed by the central banks. And when financial markets came up, it was not because they had a lot of value creation included in their pricing. It was simply a lot of free money floating around. And similarly, as I said, private equity and venture capital basically have less money to invest in startups. This is the things which actually starts affecting us even more directly. That because startups do and mature companies as well, they often then ultimately do not have the cash which they expected they would have, which is what leads to firings and mass layoffs and frozen hirings, etc. And at least in mature companies, the story can end at layoffs. In startups, the story can go to shutdowns. Everybody is just 100% layoff. Another long-term impact of this entire cycle was that many countries are in trouble now. Remember I said that in the short term, it becomes easy for countries to borrow in US dollars. So they borrowed at 0% plus, let's say 5%. And 5% is accounting for the country risk. But these rates are generally floating rates, almost always. And now the US government Fed rate is 5%, which means 5 plus 5 is not 20%, is what 5 plus 5 is 10%, is now the rate at which they have to pay interest. And countries other than US cannot print US dollar. They can print their own currencies up to a certain extent, That itself is a problem, but they definitely cannot print US dollars to return their loans. And this led to a crisis all over the world. We know some of our neighbors are actually going through financial crisis. Some similar, some African countries are also in similar crisis. Some Latin America countries are also in similar crisis. Some East European countries are also seeing some similar situations. So this is another thing which is happening right now because of the global financial ecosystem in the last few years. And I'm reiterating some points regarding printing of money. It's quite dangerous, and every civilization in entire human history has tried to solve its problems at some point or another by printing money. Now, the wise civilizations generally stop before it's too late, but sometimes they don't stop, and it always ends in disaster. Again, the reason is because money is not wealth. Simply by printing money, you cannot just create more wealth for your people. Money printing has to be accompanied by increase in value creation, better goods, better services, more efficiency, more exports. Something has to be accompanied. Otherwise, the money itself loses value. And when money loses value, you have inflation. And if you have too much money printing and hardly any value creation, then it leads to hyperinflation. When whatever currency you are holding is basically not even the worth of its weight in paper. That's how bad hyperinflations are. You'd be surprised how common hyperinflations are. Like even the last 100 years or so, we have seen many countries going through hyperinflation because they keep on printing money. Now, if now, luckily for us, hyperinflation is quite unlikely in India because of a bunch of reasons. But if any country, if somebody is in a hyperinflationary situation, your bank deposits, your money and cash under the mattress, your investment in stock markets, none of this matters. They're all gone. This is the point where money and wealth show the difference between each other in the most stark manner as possible. At that situation, you need some ability to either procure goods and services or produce goods and services which other people value. This is why gold is considered to be one of the safest assets. But more importantly, if you are in a country which is going through hyperinflation, it's good to have a business which is producing something. Have real value. Comes, money. Why haven't? Why? This is why I said in the very beginning that money is not wealth, and countries can simply create wealth by creating money. But there is an exception to this up to a certain extent, which is US. Now, at any time in modern history of Earth, and by modern I mean like last 500, 600 years, there is generally one currency in the world which is considered the global reserve currency. What does this mean? As I said, generally countries can print their own currency, but they should not. But how do they keep currencies of other countries? There are so many countries in the world. Every country has its own risk. How do you know that country will not blow up, go to hyperinflation, or just go into a war or something? What will happen? This is why for trading with other countries or simply storing some foreign currency, you need a global reserve currency. And generally, the country which produces the world's most goods and services and has the most involvement in global trade, generally that country's currency is considered the global reserve currency, because it means if you're trading with that country most often, then you can use that country's currency to trade with them. And if the country is also producing a large amount of goods and services, then you know that their currency is going to have value because their actual wealth is also increasing. And currently, US dollar is basically the global primary reserve currency. It was British pound before US dollar, but in 1944, towards the end of World War II, there was a big event in world finance which is called Bretton Woods Agreement. and you should look it up if you have time. But this is the point where uh, US dollar became the global reserve currency. Now, interestingly, until 1971, dollar was backed by gold in the sense you could always return dollar to the bank and get back an equivalent worth of gold, because ultimately gold, as I said, is one of the things which can work in extreme situations, and which also means that the the currency has some definite value. You know how much value that currency has in terms of gold. That's how it was supposed to be. But in 1971, this gold backing was suddenly stopped by the then US President, Mr. Nixon, and so it was not backed by anything. So US dollar today, since 1971, is not backed by anything. Now just pay attention to this point. So US dollar is not backed by anything. The US central bank can print whatever money they want, and every other country wants dollars with them. So even though it's not backed by gold, and even though the amount of money printed is not necessarily equal to the increase in the goods and services produced in United States of America, because every other country still wants US dollar in their reserves, this is why this much money printing has not led to, let's say, extreme inflation or hyperinflation. This is why only US can print money like this. We in India cannot do it like this. Even European countries cannot do it like this. China cannot do it like this. Because the reserve currency, the global reserve currency is US dollar. And that's an incredible privilege and power to have in the financial world for any country. Again, I repeat, that's an incredible privilege and power to have for any country. And historically speaking, it's generally only one country at a time which basically dominates this. But as I said, because every country wants dollars and they are printing more dollars, even though they're not increasing the economy that much, therefore they do not go into hyperinflation. But obviously, this has its limits. This cannot keep on happening indefinitely, infinitely. Now, what limits there are, there's no consensus. But the US central bank and the US government and everybody in US is aware that there is some limit somewhere. This is why, if you go back to this chart, they have actually started bringing the money supply down. And this is why they are increasing interest rates. They are absorbing cash from the markets, and etc. etc. Because they know this is not something which can be done permanently, forever. But now the question comes, all of this is about US. Why should we care about all of this? Like, we are sitting in India. So why should we care about how much money printing is happening in US? What is inflation happening in US? Like, why should we care? Now there are very good reasons to care. And a lot of these things impact us very directly. First of all, inflation in US is not limited to US. US produces a lot of things. US trades with almost every country in the world. So inflation also gets exported. Increase in prices in US do not remain confined to US. When US is trading, then the higher price comes to other countries. If anything is being manufactured, or any US companies or individuals are involved in making of any goods or service, then that inflation becomes priced in the final product, even though it may not be exported directly from US. So US being the largest economy in the world, ultimately exports inflation in other countries, including India. But an even more critical point is interest rates. Now, we saw US basically took their interest rates to zero, and they have suddenly, basically in a year, little over a year, they have increased it from 0 to 5.5%. Now, the problem is, if US increases their interest rate from 0 to 5%, then India has to increase their interest rates as well. Now, why is that? This is to maintain currency and Indian stability. Sorry, to maintain stability in Indian currency. Because what happens is, let's say if you are an European investor and you can get 5% interest in US dollars in a US bank versus 5% interest in an Indian rupee in an Indian bank, you are obviously going to select US dollars in US bank. Because it's the largest economy, global reserve currency, much stronger military, everything much safer. So if India has to ensure, and this is true for not just India, but every other developing country and even other developed countries as well, if they have to ensure there is still some money coming in the country, then they have to increase the interest rates. So when US increases interest rate suddenly, then other countries have to do it as well, which, as you can expect, directly impacts us. Higher interest rates affect loans. It can affect savings. It can affect everything. It generally affects loans more than savings because banks do not increase interest rate that quickly in savings, but they increase interest rate very quickly in loans. Also, every country does want foreign capital, and USD dollars is very, very liquid. So a lot of money does come into India. So when the money is being reabsorbed back from the market, then a lot of money goes out from countries like India as well, which obviously has impacts on markets and economy and everything. Another reason why we should care about these things is because a big chunk of our economy is exports. And if other countries are having inflation, if other countries people are getting laid off, then their willingness to buy things is going to be low. So what we can export will get even the amount of you think goods and services which we can export will be much lower. And this is especially true for Indian IT companies because Indian IT companies have a lot of services export and US to US, specifically to US. And US companies are in a very bad shape right now because of all of the things which we discussed. They have multiple layoffs, they have higher inflation, they have very low consumer sentiment. So they have less money to expend. And therefore, the Indian IT companies also have more difficulties in exporting anything there. Another thing is, and again, if you actually look at financial news or markets news, this might be relevant to you, that Indian markets are heavily correlated with US markets. Now, what do you mean by this? So first of all, Indian markets are quite small. And there are many types of markets. There are stock markets, currencies, bonds, commodities, etc. We don't need to go into any or details of all of this. The important point to know is that the scale of these markets globally is trillions of dollars each. And then there are derivative markets on top of these markets, and they are hundreds of trillions of dollars each. The overall derivative market, by some estimates, is around $1 quadrillion in outstanding notion. So we don't have to remember these numbers, but the main thing is to understand the markets are quite huge globally, and India is not that big. So if you look on the right, now in terms of the stock markets, we are the fifth largest. We were actually eighth largest in the beginning of 2020, like 2023, but this year, 6-7 months, we have reached like we become like fifth largest in overall stock market capitalization. But still, if you see, it's 3.4 trillion for India and 46.5 trillion for US. They're still more than 10 times bigger. And this is not like their economy is roughly around 20-25 trillion dollars. So their difference in size with respect to financial markets is much more as compared to economy. So their economy is something around 8-9 times bigger, but their financial markets are like 12-15 times bigger. So what this leads to is some situation like this. Now, what you see in this chart is the blue is the US stock markets in the last 5 years, and the orange is the Indian stock markets in the last 5 years. I have made the starting point same so as to show the actual trends. And as you can see, if you zoom out, you can basically see that the long-term trends are almost the same. When US markets are increasing, the Indian markets are increasing. When US markets are crashing, the Indian markets are crashing. When US is having a bull run, the India is having a bull run, and vice versa. There are some exceptions to this. It's not 100% 1:1 mapping, but the correlation is very high. It's like it can go up to 90%. So this 5-year correlation for the prices is 90%. I would like to have, let's say, some mathematical caveat here. This is the correlation between prices. In quantitative finance, we generally look at price returns and correlation between that. So I will not use this 90% as a number to in any financial model, but the point is to get the message across. Now, what this practically means is if something big is happening in US, so US markets open at around 7 p.m. our time or 8 p.m. depending upon the daylight savings time. And if there's anything big happening in US markets, we will see that in our night, in our evening or our late night. And if something really big has happened, and which has caused the US markets to go by, like 2% up or 5% up or 5% down, you can be almost guaranteed that Indian stock markets will move in the same direction the next morning. It's almost guaranteed. It's so heavily guaranteed that you cannot actually make money out of that because everybody knows this. So maybe if you go to the news, maybe there will be a lot of experts talking about, hey, government did this, RBI did this, fine, which may be the factor. But if something big has happened in US, that will determine what happens in Indian stock markets in the next day, no matter what RBI does, no matter what government does. And this was quite difficult for me to accept. I started my entire career has been in trading, and this was quite difficult for me to accept earlier on, especially when we're used to so many experts on TV talking about this reason why market is going up, that reason why market is going up. But you can simply see that money from US markets is being taken out, and therefore money will also be taken out from Indian markets. This is something which affects a lot of us directly if you are invested in stock markets. But it even goes beyond that, right? Like, first of all, this is not even limited to India. This happens in all other developing countries as well, and even developed countries as well. Now, I'm not saying that American markets cause this behavior in Indian markets. What I'm saying is that the factors affecting the American markets are similar to the factors affecting the Indian markets. And if they are big enough to affect American markets, they will almost certainly also affect Indian markets because Indian markets are very small compared to American markets. And this is, again, as I said, not only true for India, but true for other countries as well. And many times you see something comes in news and everybody gets scared in America. So they start taking the money out of American markets. Almost certainly they will also take out the money from Indian markets if the same people are invested in both places. So therefore it moves almost in the same direction. Also, one way to look at financial markets is as a proxy to capital flows itself. Now, this is not a very accurate way to look at it. Like, financial markets are technically referring to foreign portfolio investors from Indian point of view. This is not foreign direct investment where people are directly investing in companies or physical infrastructure. But the trends are in the same direction. So if markets are going up, then investment in infrastructure, investment in Indian companies, FDI also increasing. If stock markets are going down, then investment in companies are also decreasing. So it is a good proxy. So every time crashes happen, we can expect things to follow everywhere. Yeah. So now another question is, but there are more reasons why we should worry about all of this. And as you can remember, the topic of this subtopic of this talk was like Joe Biden stopped Swiggy discounts. Now it's nothing to do with Joe Biden, and it's really nothing to do with him directly doing anything for a food delivery startup in India. But the point is, because of the money printing being reversed, money printing first happening a lot initially and then being reversed completely. Not complete yet, but the process has started. This leads to less amount of capital available to Indian companies and Indian startups. So in 2020 and 2021, a lot of startups got a lot of money at very high valuations. Now they had so much money they didn't know what to do with this. They hired a lot at very high salaries. They did a lot of marketing and a lot of discounting, including Swiggy and many other startups. So I'm just nothing to against Swiggy. I'm just using that as an example, and it's more of a joke than any factual statement. And obviously, as you have seen in news, there's a funding winter going on. Layoffs are happening in startups left and right. Some startups are shutting down. All of these are happening because what happened in 2021 was an abnormal time which people refused to accept. That was not normal. That's not how things normally work. But many investors and startup founders assume that is the way the world works now, which has gone in complete reverse gear now. This has led to all massive layoffs and shutdowns and everything. This is why it affects us. This had nothing to do with Indian government or RBI doing anything. This $16 trillion of money was not created by India or by Indian startups or by Indian VCs. This happened outside. But that led to a lot of hiring, and now it's leading to a lot of layoffs. So this is how these things impact us very directly. A lot of other things are also happening. Interest rates India also had to increase interest rates, though thankfully not up to a very high extent. But that did increase loan payments for people and companies, and is make it somewhat more difficult to get loans. Layoffs have already talked about. Marketing spreads have also reduced, and lastly, because discounts are a way for companies and startups to acquire customers. And if they are looking at the survival, they're not going to give you 90% discount on a chicken egg roll. So these things matter. Things happening in other countries affect us very directly. Also, there's another impact of the actual physical investments in India decreasing because simply less money is available outside. Having covered all of this, I would like to point out that while US was the exception in printing money and everything compared to every other country, currently India is also an exception. Currently, India is in a very good situation compared to most other countries on earth right now. Now, this is somewhat of a Goldilocks situation. So there was inflation in India because of export of inflation from US, because of money printing in US. But unlike many other countries, India did not actually print a lot of its own currency. So it did not add to that imported inflation. While many other countries did, many European countries did, many developing countries did. But India did not. So inflation, while high overall, is not as high as what we have seen in the past. As recent as 2013, we have seen double-digit inflation in India. But it was not that bad right now. Plus, while the liquidity, the cash, the money is being absorbed back by the US central banks, the amount which is left, a larger portion of it is still coming to India because of a lot of reasons. First, Indian economy is doing well. The fundamentals are in somewhat good shape. A lot of Western investors have put their money in China, and there are a lot of geopolitical tensions as well as supply chain issues in China. So they are taking the money out, and some of it is going to India. Some of it is going to Vietnam, Thailand, etc. But a decent chunk is coming to India. Plus, Indian banking is also quite strong compared to what it was in a few years back. A few years back, it was in a horrible shape. So many loans were in a very bad shape. It's much more cleaner now. So the fact that Indian domestic factors were relatively strong, plus the remaining money had to go somewhere, plus the geopolitical tensions with China and the West, it led to a situation where India still gets decent amount of money. Now, the Indian startups are not getting that much amount of money anyways, but they're still getting a lot of money, even the funding winter, compared to many other countries. And one thing which India, as I said a bit earlier, does well is we do not borrow in foreign currencies a lot. This was a decision taken a few decades back by some government, which has continued across multiple governments. We do not borrow heavily in US dollars. We try to borrow in INR because that means we can simply print INR and pay it back. Obviously, that is not a good thing to do, but it's definitely better than borrowing in US dollars because you can't even print dollars. So which means that when US dollars interest rate changed heavily, then the sovereign government borrowing of India was not that heavily affected. But having said all of this, this is a kind of a Goldilocks situation. Things can always change. So we need to be very aware, we need to be very careful. Now, with all of this, the question is, what can we actually do? You know, we got a lot of information about, yes, financial markets, money printing, inflation, and how it impacts us, how it impacts inflation in India, how it impacts our jobs, etc., etc. But the question is what we can actually do, and that's what the remaining part of this talk will cover. So basically, the first thing is to understand and accept reality. The fact of the matter is decisions taken by people in countries far, far from us can affect our daily lives. That's the entire point of this talk. We need to be aware of this, we need to accept this. As I said, for me, it was quite difficult to accept, to just understand that Indian markets can easily be dictated by something happening in US. Something happening in US politics, US Senate can move Indian Nifty and BSE Sensex. But this is the reality. We cannot hide from it. We cannot run away from it. So this is what first we need to do. And then we need to understand all the things like financial markets, money supply, which I talked about. We need to be aware of interest rates, how it's changing in US, how it's changing in India, and we need to understand how all of these things affect companies, startups, economies, markets, everything. The problem is, and it can be quite difficult to accept this kind of reality. Obviously, it has been difficult for me, it's difficult for all of us. The problem is, it's often difficult for people whom you think to think deeply about these topics. These would be CEOs of big companies, these would be CEOs of startups, etc. Now, many tech companies in US are just firing like anything these days because they also made some similar mistakes. That money printing in 2021 was not a normal situation, but they basically assumed that they are getting a lot more revenues and a lot more business because they are doing something right, and they'll be able to continue doing this forever. They simply refuse to accept the reality that it's not normal situations. They hired a lot, they spent a lot, and now they're firing. This problem is even more severe in startups. A lot of startups founders basically thought that we are able to raise so much of funds because we are geniuses, which may be true, but the fact here is there's a much bigger force in play. And even if you're Einstein, you don't control that. Now, if your expenses are with respect to that high amount of money you raised, then you are done because you cannot raise that much money again. So you have to fire people or you have to shut down the startup. The problem is that this refusal to understand reality even goes beyond the business world. It even happens in policymakers. It even happens in central bank decision makers. There was a refusal to accept, even in the US, that the inflation is becoming a problem. There was a lot of pushback. The central bank decision makers themselves said no, inflation is only transparent, only happening because of supply chain issues, not happening because of money printing. They kept on pushing until it was too late and inflation was very high. So understanding reality is the first step which we should do. And if you accept what is actually happening, then you are already ahead of most people on earth. Now, the next thing we can do is to make better decisions based on this knowledge. So first, in the context of jobs, so if any students here listening to this, please understand what happened in 2020 and 2021 was not normal. Do not expect that kind of placement cycles. That was not normal at all. If you forget this, go back, look at the money supply chart, look at the vertical in 2020, and then come back. Now, let me tell you one legendary story in a placement cycle. One of these day one stories. There was a good candidate from on day one placement who a lot of multinational companies wanted to hire, and he was given offer on day one by many multinational companies, and he went to one of the companies and said, I have a lot of offers. So he said, okay, we will give you 50% more money. Then he said, that's not enough. Then he said, okay, we will send you to US, you can work directly there. He said, no, I don't want to go to US, my friends are in India. Then the company said, okay, you stay in India, we will pay you the amount equivalent to your salary, which would have been your salary if you were in US. Which means, being in India, he was offered the salary given to people employed in US. Obviously, he accepted that. He was very happy. He started the job in a few months. And unfortunately, within a few more months, he was laid off from the company. Not because he did anything wrong, but because the financial markets changed. Global economics changed very quickly. Now, my question would be, which year do you think this was? Was it 2019, 2020, 2021, 2022? Which year would you think this was? Now, the answer is, it was none of this. This is a story from 2006, and this is not an IIT day one story. This is an IIM day zero story. And the company being offering the job was actually an investment bank, and they were not sending the person to US, they were sending it to Hong Kong. And this is a very legendary story which goes in IIMs all the time. The point of the matter is, there was a huge bubble in finance, especially hiring in finance at that time, in 2006. And in 2008, basically 2007 towards the end, and 2008, the bubble blew up, and a lot of people were fired. And financial salaries, investment bank, financial hiring never reached back that level. That kind of bubble never happened again in finance. But similar things happened in tech in 2020, 2021. Freshers were being offered 1 crore salary in India, being given bikes and Disneyland trips and whatever. These things are not normal. And it's very important to understand this. You cannot make your entire trajectory of life based on an event so rare that it has never happened in the entire history of humanity. So keep in mind that these kind of stories are a sign of a bubble, and they do not repeat until the next cycle, which might be 10, 20 years and might happen in a different industry. Now, if you're not even a student, but if you're a working professional already, you still have to be careful when you're searching the jobs in such situations when financial markets and there's a lot of money supply going around everywhere. If a different company is offering you 50% hike, 100% hike, 200% hike, always give a thought whether it's really because of your skills or simply because there's a financial bubble going on, which is temporary and it's going to burst anytime soon. So you have to be careful. And this is why it's important to understand what's happening in global finance, global financial markets, economies, money, liquidity, everything, to be able to take better decisions, to understand what things are permanent, what things are temporary. Also, when you're searching jobs, you have to be careful how critical your role is. If you're not making something or selling something, then your job is not a priority for the company, especially in startups. Keep this in mind. If you're not making something and if you're not selling something, then a job is not a priority for a company, especially in startups. So I'm not asking you to not take those jobs, but if you're taking those jobs, be aware of the global financial conditions, global macroeconomic conditions, condition of your economy, condition of US economy, condition of the entire planet. If you want to go to somewhat tangential role, do not do this at the peak of a bubble. Like if some lot of people change their jobs at the end of 2021, move to startups or move to completely different roles. But that was the peak of the bubble and it burst. And it's very difficult for them to get a jobs now. Also, keep your expectations realistic. This is true for both students and professionals. Again, that period is not normal. So don't make your salary expectations based on that kind of period. So don't price yourself out of market. Don't assume that as a college fresher you will get 1 crore in Bangalore, in India, just working from home. That's not normal. It can happen in some places. It can happen if you're taking a job directly in US. But these things are not normal. So don't keep an expectation at such a level that you can become unemployable. Because as I keep on repeating, what happened in the 2 years, that was not normal, and that's not going to happen again for a while. Also, be careful about layoffs. The layoffs are happening everywhere, industries and big companies and startups. So be careful which department has revenue generating functions and which departments are moonshots. Moonshots are good for career growth. So you have to go to those kind of departments some point in time. And you obviously have to go to startups if you really want a big career jump, if that is a possibility. But you should completely be aware of the cash flows of the startups, the cash flow of the company, the liquidity of the company. Are they getting revenues or is it completely VC funding? And if it's VC funding, how much VC funding they have? Do they expect that they will simply be able to raise as much money as they raised in 2021 in 2023? If yes, then you should head out because that's not going to happen. So these are the things which you should know, understand, and keep in mind to protect yourself from decisions done in countries far away from you. Now, there are other type of decisions as well, which you can do better if you are aware of these kind of things going on in the world. When you're taking loans, obviously be aware of interest rate changes. If an interest rate change is being done in US, it's very likely to be done in India as well, especially if they're increasing interest rates. Now, thankfully, recent times, as I said, Indian economy is quite resilient. So that level of follow-up rises in Indian interest rates has not been required, but Indian rates have been increased quite a bit as well. So if you are taking a floating interest rate loan for buying a house or a car for 30 years, And if you're taking it at a time when the rates are very low, keep that in mind that rates may not always be low. They will change and they can change. So keep that in mind. Also, if you're taking up a lot of EMIs, keep in mind the legal obligations. If you're taking a lot of loans for buying a lot of assets, cars, and houses based on your salary in 2021, then you may not have that salary in 2023 or 2024, but you still have to pay the EMIs and their legal obligations. Not only your assets will be seized if you do not pay back the loan, if by any chance you gave a personal guarantee, you can even go to jail. So you have to be extremely careful. And also, as I said, uh, whether or not your job is guaranteed, you have to be careful. So if you don't have a job, it's very difficult to pay back loans. So keep that thing in account. And lastly, when it comes to investments, if you're investing somewhere, you have to be obviously careful of these factors. As I said in the beginning, I cannot give you any investment advice. The only thing I can say is you have to be careful of cash flows, like global factors, interest rates. This thing will directly affect stock markets, for example, very directly, very immediately. So if you have money in stock markets, you have to take care of that part. And obviously, if you have money in fixed deposits in banks, then interest rate changes will affect you. And as I said, changes in Indian interest rate may not only depend upon Indian factors, but can heavily depend upon American factors. And lastly, as I said, it's try to attain true wealth and not just money. In this case, as I described in the very beginning, wealth is basically the ability to get goods and services of value, or ability to produce goods and services of value. And that's what you should try to create. That can protect you in inflation, hyperinflation situations. And if you are aware of all these factors in a bubble period like 2021, you can get more cash, use that as investments to maybe create businesses or something which produces value or some amount of ownership in business, which can help you in the longer term. But again, this is just a very high level suggestion. This is not really financial advice. Obviously, do your own research before putting even 1 rupee of your money anywhere. Yeah, and lastly, use this financial awareness to your benefit. While we obviously cannot control any decisions, like most of us cannot control anything happening in India, any RBI decision, government decision, anyways. We definitely cannot control anything happening in the US. But if we understand what is actually happening, we can use them. For example, in November 2021, Jeremy Powell in US, who is the US federal chairman, had started giving hints that he will raise interest rates. So everybody in financial markets had started accounting for them. Now he increased interest rates a few months later. But if you are aware of this, then you know that US is going to increase interest rates. Therefore, India is also going to increase interest rates. Therefore, your loans, your deposits, these are all things you can manage. And then if you know that financial situation is going to change significantly, then you can take better decisions about your jobs, about your investments, etc. So again, and as I said, my last point is do not make permanent decisions in your life based on what happened in 2020 and 2021. That was not normal. That will not happen for a while again. And do not assume that just because you got some jobs or some investments in that year, you can continue doing that the rest of your life. That's not normal. Things change a lot. Financial forces are very strong. They're stronger than individuals, they're stronger than companies, they're stronger than countries. So understand these trends. Don't try to fight them. A good idea is to ride the trends and make the best use possible. So that's all I had to talk. Thanks for listening. And I hope this is useful. And at this point, if anybody has any questions, happy to answer.
Excellent. Thanks a lot, Deepanshu. So there are some questions. I hope you can take a look at the chat.
Yes, I will have a look at the chat now. Yes. Okay, background also resolved. The switch and get teacher get poor for inflation. Yes, that's a good question. Inflation definitely affects poor a lot more than rich, but it does affect everyone. So, like if you're really poor, what people often don't realize is your entire day is spend just looking for food. Like if you actually go and talk or live your life as a natural poor person, you'll understand the entire faking hours is just spent worrying about food. And if inflation is happening, food prices are rising, this affects them significantly. Now, the rich also affected by inflation because the value of their assets drop, the money which they have loses its value. But they also have means to protect themselves against inflation. As I said, one of the ways to protect against inflation is by owning value creating businesses, or just having the ability to get value, which is really not possible for poor people. So while it affects everyone, it affects poor more, and rich have means to defend themselves. So US will find they will use this situation to restart printing, and yeah, that's a good question. So uh, so basically they are already printing. It's not like they're going to restart. They are already printing a lot. There, as I said, many various forms of printing. Like the central bank is taking out money. So in that sense, they're not printing anymore, and they're increasing interest rate. But the government is expending more and more and more. So the last type of money printing, which I talked about, that is still going on. Because I said, government sells their bonds to the central bank. By selling the bond, they're basically taking a loan from the central bank, and this is what the debt limit is all about. So by increasing the debt limit, they basically started printing money again. So this is the fiscal printing, not same as monetary printing, but it's going on, right? So the so so interest rates are definitely increasing now. There's a chance that, based on the recent comments by Jeremy Powell, this might increase maybe once or twice even further. So from a liquidity perspective, they will obviously increase the interest rates, take out cash from the markets, and they are not going to reduce the interest rates until they are certain inflation is in control, which may be 2023 and in the best case scenario 2024, 2025, nobody knows. And if you can predict it correctly, you can actually trade and make a lot of income. Yeah, so I guess those are some of the questions.
I had a question. Can I ask it verbally?
Yeah, sure.
Thank you for the presentation. This was very interesting. So one of the charts you showed showed that the US printed 13 trillion or so after 2020. Now, China looks at this and says that since Deng Xiaoping and Jimmy Carter signed the deal in 79 to make China the manufacturing hub, all we have to show in terms of profit is $3.3 trillion. And the US goes away and prints $13 trillion and passes off inflation to the rest of the world. So, do you think that China is reversing that coupling with the US by means of starting bilateral trade in their local currencies? And other countries are also moving away from USD in trade and possibly backing it with hard assets in the future?
I mean, that's what the talk is today all about. Like, everybody's talking about basically decoupling from US dollar. So China is definitely trying to have its currency being used as for trading, like physical trading, as well as a reserve currency for some countries. Now, China has basically two reasons to do this. First, obviously, no country wants to import inflation because of what's happening in the US. As you already touched upon, that they had an agreement, they will print this much, but they have printed so much, and it's affecting China a lot. But but one thing which I did not touch too much upon this call was geopolitical aspects of currency. And the US dollar has been used for sanctioning people and countries recently a lot. And China is worried that many people, companies, and countries might be sanctioned in China as well. So they want to reduce their dependence on US dollar. This is a concern for every other country, to be honest. And even India is trying to reduce its dependence. Now, the problem with China is that the currency is not easily freely convertible. So even if it's the largest manufacturing hub of the world right now, its currency cannot be converted easily because they have put restrictions. Their currency restrictions are similar to what India has. That becomes very difficult then to use Chinese currency as a global reserve currency or a means to trade. Though it is still possible to use that in a bilateral manner. So this is why China is trading a lot in the making bilateral trading arrangements with Brazil, UAE, Saudi Arabia to trade in yuan because they don't have to worry about convertibility in that case. So everybody is trying to do that, but it's very difficult to do because it's not like if people are worried about US government sanctioning them, then people are even more worried about Chinese government doing something in the future. So it's very difficult for people to run away from US dollar and accept Chinese dollars. And backing with physical assets is definitely a theory which has been floating around. And if you remember in my talk, I talked about that US dollar itself was backed by gold in 1971. And that is a good approach. And there's the news about the BRICS group, Brazil, Russia, India, China, and South Africa, trying to have a gold-backed currency. But these things are very difficult to do. And these things take a lot of time. Like these things take time in the context of lifetime of countries. These things take bigger than human lifetimes. If some changes start, maybe we have already seen the start of these changes. Maybe a physically backed BRICS currency might come sometime in the future, but it's not coming next year. It might come 5 years, 10 years, 20 years down the line. Or CBDCs might come, they might change the game, or cryptocurrencies might come, they might change the game. Things might happen. So what you're saying is definitely possible, though I'm not sure about how realistic it is and if it is realistic, how is the timeline?
Thank you.
Any other questions?
Great. So, I will make available the presentation data as well. Yeah, go ahead.
So thank you very much, Deepanshu.
No, my pleasure, Aditya, and thanks for inviting me for this talk.
Thanks a lot. Thank you everyone for joining in. Thank you. Thank you all. Have a good evening. Bye.
Bye.